Welcome. I'm Ed Sullivan, Group VP and Chief Economist at the Portland Cement Association. With this video, PCA launches its first monthly market briefing on national and regional trends that are impacting our industry. This report will be given the third week of each month. I will conduct the national overview. Dave Zwicke will conduct the regional overview. So with that, let's get started. The first half of this year, the economy had several curves thrown at it. We saw weather in terms of snow, rain, and flooding impact economic activity. We saw the price of oil decline and the disruptive impacts that had to certain regional economies without seeing the positive benefits coming from the consumer end. We saw a strong dollar make it tougher for the manufacturing industries to export in an already challenging international environment. We had a dock strike in California that disrupted economic activity. On top of that, the Government Bureau of Economic Analysis suggested some problems with their seasonality. At the end of the day, we came out with a first quarter GDP estimate of negative 0.2. That leads some to question, are we in an era of slower than expected growth? And I don't believe we are. In May, we created 280,000 net new jobs. That occurs in the context of already low unemployment rate. Wages are expected to rise. Inflation still remains low, and it gives the Federal Reserve more time before it has to embark on a decision to raise rates. Wealth and financial assets, home prices are all strong and gives a little extra footing to consumers. And when you look at the consumers, they are positive and gaining strength as consumer sentiment rises. What you've got is a situation whereby the consumer is willing and able and getting stronger. That accounts for 2 out of every $3 this economy generates. Now, the fundamentals are in place. And it's not just consumer, it's the banking industry, it's investment activity, it's broad. We expect an acceleration in economic activity to occur in the second, third, and fourth quarters of this year and carry forward. So what does this all mean for cement? Well, we have a forecast out of 7.5% growth over 2014 levels. And through the first quarter, even despite some of these curves facing the economy, we achieved a 5.5% growth. We had always anticipated acceleration during the second half of the year. We dealt a blow in May when we saw a 5.7% year-over-year decline for that month. That's when the flooding hit. It hit big states like Texas, which impaired our growth. The issue is whether we can make that 7.5% given the setback in May and the slowdown in April. To do so, we're going to have to average something near 100 million metric tons on a seasonally adjusted annual rate basis. And that has to extend through the key pouring season, May through October. Now, 100 million metric tons seasonally adjusted has been reached recently. It was reached in December. But prior to that, we went 78 months before seeing a 100 million metric ton market. Can we make it? Yes, we can. But it could be difficult and there could be further challenges. Flooding again is materialized in June. So when we look at this, what we're suggesting is that there's at least the possibility that PCA will downgrade its forecast. How much? We don't know yet. Alluding to the fact that perhaps the 7.5 could be a little bit strong for this year. With that, I want to thank you for tuning in.
My name is Dave Zwicke, the Senior Regional Economist with the Portland Cement Association, and I'd like to provide an update of regional economic trends. Starting off with employment, we find employment is a good regional indicator for economic health by state, as well as while it is a lagging indicator in terms of economic activity, we find when sustained on a sustained basis, it provides a good proxy for future construction activity. As more jobs are created, it creates more demand for public services through higher tax revenues and also more demand for non-residential and residential activity. Looking on a regional basis, we find that the Pacific region is by far the largest job creator so far this year in the U.S. In terms of unemployment rate, jobs created, and year-over-year growth, Pacific has led the nation in terms of growth. And one trend we're also finding, it's more so in the Pacific, but also throughout the entire U.S., we're seeing a very high tightening of unemployment rates in the U.S. As unemployment rates tighten, we expect to see more pressure on wage growth, and we think that this will also actually help household formation going forward. So one thing that's been lacking throughout this recovery is household formation, and that's been a drag in terms of residential construction activity. So as wage rates tighten, or unemployment rates tighten, and we see more pressure on wage rates, we think this is going to be a catalyst for future growth in terms of residential construction. Right now, we're definitely seeing that in the West, but it's a pattern we're also seeing in the Southeast and South, and we think that's really going to be a kind of a broad trend we'll see for the next few years and help support our outlook in terms of residential construction. But returning back to employment trends, following the Pacific, the Northeast and the Southeast are also very strong job creators. They're not as strong as we're seeing in the Pacific, let's just say the West Coast, but it's still a very strong clip of job growth. In terms of the Northeast has really been seeing more job growth in the Mid-Atlantic sector relative to that of the Northeast, and that's largely due to the strong job growth in New York City. In terms of the South starts from Texas and ranges over to the Atlantic coast, and we're seeing much stronger growth in the Southeast, particularly in Florida, than we are in Texas. Texas has historically been a strong engine for job growth throughout the last few years, but we have seen the momentum slow down in recent months. Particularly in March, job growth declined for the first time in 5 years in Texas, and that's largely due to decline in oil and gas services jobs as a result to declining energy prices. As energy prices start to stabilize in the range of about $55 to $65 a barrel, we think some of that drag on oil services will diminish going forward. So as a result, that decline in Texas we don't think is an indicator of a change in trend going forward. Texas still has a very diverse economy and positive demographics, and we think there's going to be continued growth both economically and in construction in Texas. Turning to the forecast, we're finding that there's really a shift in trend from what we've seen in the last few years. In the last few years, we've seen a quarter of growth in terms of cement consumption, ranging from Texas north to North Dakota. And while we've seen weaker growth in terms of the coasts. Going forward for this year and the years ahead, we expect to see a little bit of a shift, higher rates of growth on the coast, particularly in the West, but also in the Southeast, relative to that of the interior U.S. There's really two main factors driving this. For one, the interior U.S. has been in a more advanced state of recovery relative to the coastal regions, and some of these states are actually have surpassed past peak levels in terms of cement consumption. So as a result, we expect to see a deceleration in terms of cement consumption growth. The second part is the central U.S. has more exposure to oil. And as oil prices decline, we've seen a dramatic decline in oil rig drilling. Therefore, there's a direct impact on cement consumption. To kind of put this into perspective, when we did our national outlook back in March, based on the available information in oil outlooks, we expected about a 35% decline in oil rig counts. This has, again, a direct impact on cement because of the cement oil well cement being used in the drilling, but also in the terms of indirectly through like residential and public works projects, but as much of a long-term trend. But based on our original outlook, we expect about 35% decline in oil rigs in the U.S. in 2015. Well, we released our state forecast about 8 weeks later. We reassessed the current information. We found that oil rigs were actually falling about 45% on an annualized basis. So taking in this account, the state forecast does have a little bit lower volume and therefore a little bit less downside risk in terms of the outlook based on its new oil assessment, but it's definitely something to keep in consideration. And as I point that out, we should say that the last few weeks we've seen even more decline than we expected when the forecast was released. So there could be a little bit more downside risks in some states such as Texas, Oklahoma, North Dakota due to their oil exposure. But the good news is oil rig counts have really steadied out in the last few weeks. Therefore, that downside risk is minimized, but we'll definitely keep an eye on that in terms of the risks for the cement outlook. In terms of the overall trend, again, we expect to see much stronger growth in the next few years in the Southeast and the Southwest, and this is due to positive demographics, job growth, and we're seeing a very strong rise in permit activity in terms of residential starts. We think that those states will have much stronger rates of growth than that of the interior U.S. Turning to the regional trends, we're looking at cement consumption year-to-date through May. These are based on data through the USGS through April with our estimates based on dues in May. And based on the current year-to-date trends, the Great Lakes have been the strongest category year-to-date. We're seeing a double-digit growth rate in some of these states, but we'd like to add some caution that while those rates are very high presently, it's due to a very seasonally weak construction period. In January, March, and February, we tend to see very low cement volumes, so it's easy to see those growth rates be distorted. As we move into more meaningful high-volume months and the summer months of construction activity, we expect to see some moderation in terms of the growth rates we are currently seeing year-to-date in the Great Lakes. The West is also seeing very strong rates of growth in terms of year-to-date, and given the less seasonality, we're optimistic that those trends will be continued throughout the year, and it's also supported by strong permit activity we've seen in the West and also in the Southeast. The Southeast has been a little bit of a laggard in terms of year-to-date cement consumption, but again, with strong permit activity and strong job growth, we expect to see an acceleration in the summer months. There are also, in the quarter of the U.S. from Texas on north, there's a number of states with marginal declines year-to-date through cement consumption. We think part of this, particularly in the South, is due to weather patterns. And we think once weather patterns subside, we start seeing strong construction activity throughout the summer months, those declines will also moderate and turn into positive growth. But generally speaking, throughout the U.S. and both regionally, we're very optimistic in the prospects for growth. I mean, this recovery is very broad-based and will continue for through a number of years. And with that, I'd like to end this current update. And if you have any questions, please contact myself or Ed Sullivan from the Forecast Outlook.